It is my view that why we have capping of interest rates today is because of what I would call massive policy failure. That over time, things that should have happened didn't happen. Alternatives, which are policy alternatives, were not carried through and were not seen through. And therefore, the end result is that my colleagues, members of parliament, were of the view that the only panacea for that is to regulate and cap the interest rate. I did argue then, and I wrote in the newspapers, that the disease that we are trying to cure cannot be argued. It was there and it was real. But unfortunately, the solution we were advocating was simple, was direct, but it was wrong. It was wrong because history has shown us that once you liberalize markets and once you open that door of free markets, trying to come back to that creates far bigger problems than the original problem you're trying to solve. It was my opinion that we have not exhausted, and we had not exhausted by that time, the alternatives that were there to using regulation. And I'll just mention a few. For example, we all know, and we're talking about it everywhere, about the effects of massive dependence of domestic borrowing to finance our budget. And that is the biggest problem we're having. Mwai Kibaki, in 2004, did not cap the interest rates. Yet, we were on single digit. Why? Because he went for the cause-effect relationship about the various options within the macroeconomic management of our economy that was available for him. So he didn't come to parliament asking us, please cap the interest rate. So what did he do right in 2004 that we cannot be able to do today? Why are we borrowing? Why is government borrowing from banks so heavily in a way that crowds out the private sector, the SME, and the small mwananchi from borrowing? Until we ask ourselves that question, going for capping through legislation actually puts our monetary policy and our monetary mechanisms into a trap. And that is what I argued 2 years ago. Sadly, it is not every time you are happy to be proven right. So in this particular case, I'm very sad that I have been vindicated after 2 years. Actually, all my predictions, the shrinking of the credit, have been proven right. The only one prediction that I was wrong on is that our Tier 2 and Tier 3 banks will collapse. None have collapsed. Well, there's no bank that has collapsed since the actual implementation of capping. And why? Because, again, where they would have collapsed, and maybe it was not bad for them to collapse, but where they would have collapsed, they were saved again by our monetary authorities, by our policy authorities, because where they couldn't lend to mwananchi, they could lend to government through the treasury bills, which have remained the same. So maybe if the right things are done, we may start to see a correction phase within our banking system.
But recognizing this issue, I remember in 2014, I constituted an interest rate committee to look at this matter because I knew it was coming. And I did try to look for solutions. As you recall, it was that time that we introduced the Kenya Bankers Reference Rate, what is called KBRR. We did ask banks to develop the APR, and a number of reforms that we were doing. Obviously, reforms take time, and we were caught up by the proposal by Jude Jomo to cap rates before some of these reforms actually could happen. But our approach was really, let's attack the root cause of high interest rates in Kenya, as opposed to second-best solution, which is more of controls. Controls do work, but temporarily, as you fix the structural problems or the root cause. So ours was really a fast-based solution, which is really to look at the costs, the structural problems, that why interest rates are high in the first place, and then find solutions for that. So there are many reasons why interest rates were high. Some of them I've already mentioned in terms of the loanable funds, the structure of our banking system. The high interest rate spread is also associated with many things, operational costs that are high in this country. There are also other financial costs, including cash ratio requirement by the central bank, and a number of them. We looked at all those and we see which ones do we need to address. So we were still staying on that course, despite even the regime that we have now of caps, to continue to address that. And our hope was that if these reforms can move quickly, we will not require really caps and they will anyway become redundant. But what has happened since 2016, the objective, of course, for capping was that the idea was to reduce the cost of borrowing. That was one intention. The other one was to expand access to financial services. And the other one was to increase the returns on savings as the main objective of that cap. 2 years down the line, what has happened? Whether we have increased lending or access is an issue. And our analysis do point that actually it has had unintended negative consequences. And this was expected anyway. I mean, we have seen what is happening in other economies. You know, Kenya is not the first to have had caps. In fact, when we introduced caps, it's the first time I tried to do some research a bit to find out how many other countries are doing the same. And there were quite a number of countries, but not the caps that we have. The way they use caps is a bit different. But they have also learned a lot of lessons. Some have completely removed them. Others have really, the caps are there in the law, but they are redundant. In other countries, like in Latin America, they were set very high. Now the interest rates are low, single digits, and nobody even applies, but they're in the law, but they are just redundant. So the countries do have caps, but they are not very drastic than the one that we have. In fact, to my best of my knowledge, the cap we have is draconian. It is really drastic, where I say so because ours has a ceiling and a floor. All caps in the world don't have both. Mostly just have a cap or so, which is used for other purposes like usury, to deal with predatory lending behavior. But ours is quite unique, and that is why it has had even much more negative consequences that ideally caps would have. So, and again, you see, at the time of caps, I think from the analysis that we have, about 53% of credit were actually, 53% of the deposits were actually below the 7% that was the floor. And about 60% of credit were above the 14% when it started. So you can see how the effect it had. Anyway, what do we see now? Of course, the intention of the bill was really to get people get more credit. But what we see is that we don't, a lot of small or medium-sized farms are not actually getting. The data is very clear. It speaks for itself that bank credit to these sectors has actually dried up in some cases. It has hit small banks more than the big banks, because big banks are still able to lend to big borrowers. So you can even see the average lending rates, the average credit has actually increased because of the big lending to big organizations as opposed to the small ones. Banks have also become, ingenious. You'll see them. They have introduced non-interest earning deposits account to avoid this, or they have introduced other levies to compensate for the interest rate income that has come down. So it does become defeatist in a way. And this is based on analysis. This is not, it's good that we had the caps so that we can actually do them work and see, compare. This is based on what has happened in the last 2 years or so. So this sort of now informed us really to make this decision that I think for us to move forward, the economic agenda that we have ahead of us requires a private sector that is active. It has to be able to lend. We are going to rely on the private sector to fund the Big Four agenda. And if we are actually going to talk of Big Four and we have interest rate caps, I think we better just forget about it. It's not going to happen. With this type of lending that the lending regime that we have. And that is why you saw in my budget speech, I did indicate that yes, we are providing resources to Big Four, but we are going to rely on the private sector, PPPs. Somebody has mentioned PPPs here. But if we are talking of PPPs and the private sector, they must get credit. And to get credit, they must access. It's true, yes, it's expensive, but we need to lower by really looking at other means, and that is why it takes me to why we have tried to find other sources of cheap funds. I think Mheshimiwa Kuria said about the Kenya Development Bank we are setting up following amalgamation of some development financial institutions. Our intention there is to see if we can raise cheap funds and on-lend to the private sector. We have also amalgamated all the funds. We had the Youth Fund, Women Fund together so that we can create a big Biashara Fund, again to lend to SMEs. We are discussing with banks to come up with a SME fund and a national guarantee scheme. All these are designed to address the problem that interest rate cap proposal was actually intended for. And if we do that well, I believe we can get around this problem that we have in high interest rates in Kenya, provide funding to SMEs, jumpstart the economy as we work through the underlying root causes, and we have already started on that. The things, collateral reforms, reforms in the land registry, judicial reforms, supporting the banking sector and the like. This takes time. But for short-term measures, instead of the cap, because we see it's really having an unintended consequence, we are better off doing other things like looking for credit. Even in the housing sector that we are talking, affordable houses, we already registered a new Kenya refinance mortgage company, which is going to mobilize long-term credit for that.
In 2006, like you have said before, Banking Amendment Act 2016 was assented to by the President. And the main reason of moving that bill was because the banks were misbehaving. The banks had colluded, and interest rates in Kenya, I think, were the highest in the world. And people were complaining that they want to do business, but they are being charged interest rates of 18% up to even 30%. And it is quite obvious that when you have a business where you're making about 30% profit, you're in a good business. But all the profit that you make is eaten up by interest, because if you're paying 28%, then you're making 2%, that pays for your overheads and everything else. So it did not make sense at all. There were many moves to try and push the interest rates down. Central Bank had also failed its duties in regulating the interest rates that were being charged. And like the CS have said, the introduction of KBRR did not have any effect, because they were just marking up on the KBRR. And the whole country was in hue and cry that we cannot be able to do business. Banks are siphoning every profit that we make. Now, to add insult to injury, if you would go through the annual accounts of banks, they were making so much profit so that if you compare with other businesses, if you compare the 10 most profitable organizations in the country, 7 of them would be banks.
Only 53% of customers truly were beyond the 14%. There are many customers borrowing below, many customers. And so there couldn't be any collusion. It was what I can call a normal curve. And I think what needs to be done more, and we had what we are welcoming is a conversation happening today to address the specific issues. What I find from our customers that I speak to many times, Terian, which is a big worry, is many customers say they need access to credit today at whatever price. That's what they always say. They are a business to run. And I think banks, people see the numbers because we're regulated and we're among the industry that publishes our results by law. That is a requirement of the Banking Act. There are many businesses that never publish their numbers. If you do, you will see different performance actually that happens. And I think we need to find a way to deal with the high interest rates today, rather than dealing with one universal measure to cap every other industry where the credit portfolio risk profile is not addressed. That is the issue that I have a difference with the model. But in terms of the rates, I think the industry agrees very much with Julia. We need to address the issue of interest rates.
Since the cap, between 2016 and 2017, 1.23 million borrowing customers have stopped borrowing. 1.23 million borrowing customers have stopped borrowing. That's a big number. Beyond that, the average loan amount during that time has grown by 47%. What does that tell us? It tells us the rich and the big companies are continuing to borrow. So what Honorable Jomo wanted to help, the SMEs, the individuals, those are actually the ones that are not borrowing in this market. So for me, it is to think about, I think Honorable and ourselves talk about the same language. We want to help SMEs. We want to make it affordable. We want to make it accessible. If we're talking about SMEs, yet the people, the statistics show, are being wiped out of the market.